Today we're going to be doing our monthly market report for the trailing 12 months through July of 2022 for the northern half of Florida, everything over 10 units, conventional, student housing, and affordable. I'm going to go over a couple of things that I'm seeing, some trends, and maybe some predictions. Stick around. Let's go! The first thing I'm going to do is orient you with how the spreadsheet is set up, and then we'll start diving into some of my interesting things that I'll point out. The first thing we're going to do is go over the 100 plus unit stats, and then I'll go over the under 100 unit stats. As you can see here, for the trailing 12 months, there have been 91 total closings. Then I have them broken down by classifications, Class A, Class B, and then I have them broken down into subclasses. So the 46 closings is the summation of B plus B and B minus. The same thing for Class C, that's the summation of these three categories. The 91 closings pertain to just conventional. On top of the 91 closings are the 16 student housing deals, which I track as one line item, and affordable housing, which I track as one line item, because there's never that many sales to be able to predict from. The first thing is that the 91 closings you see here is trending up only about 5 or 10 closings from historical. The average overall age in place is a 1985 asset. We're trading in $153,000 a unit on median. These are all median numbers, which comes out to $93,000 a bed. I know these are for conventional stats, but I track them by bed as well. A $1,300.23 rent, and we got a 10.19 gross rent multiple. As you know, gross rent multiples were how many times the total annual revenue trades into the purchase price. As you can see in my Class A stats, Class A is almost exclusively new construction assets. There have been 19 new construction sales with a median age of 2020. We're trading at $264,000 a unit, but I can tell you right now the trailing 3 or 4 month stats are closer to $300,000 a door. You've got $1,864 a month rents, and we're running over a 13 gross rent multiple. Now, I'm not going to go over each row. I'm going to point out some interesting things. There have been 46 Class B closings and 26 Class C closings. There usually are more B class closings than C class closings on 100 plus units, but this particular trailing 12 months, there have been a lot more Class B closings, and my thought is it's because there were so many Class C that was bought in the last 5 to 6 years that have been renovated and value added, and now come back to market and sold as a Class B. Another interesting stat, Class B, while only 11 closings, are typically in the early to mid 2000s, and even those are going for $231 a door. Traditionally, the Class A new construction was in that price range, and those B pluses are getting $1,600 a month rents and nearly 12 gross rent multiples. On the Class C side, a couple things to point out is that as you can see in the Class C minus, there were 0 closings for the trailing 12 months on 100 plus unit conventional deals. Now, I consider Class C minus what you may consider a D. It is the bottom of the bottom. These are very high delayed maintenance assets in bad locations with high crime, and you really have to want to own something like that. Now, traditionally, what I have found in the 100 plus unit world, there's not a whole lot of those assets that exist because they've been bought and value added to at least a C or C plus. The C minus is you traditionally only see in the under 100 unit world, and traditionally under 60 or 70 units at that. Pay attention. I'm going to show you some really interesting things on this 100 plus unit conventional side, and I'm going to tell you what the sweet spot is to buy, and you're going to want to be paying attention to this. Okay, so look at these C-class stats. You got $75,000 a unit, and if you can value add to a C+, you got $23,000 a unit jump. Not too bad. Let's say you buy a C-class, you put $6,000 or $8,000 a door in it, you still have a nice delta to be able to make some profits. And these C pluses are getting $950 a month rent, which is not too bad. Then to go from a C plus to a B minus, you got $37,000 unit jumps. That's a nice little one, and you're going up almost $250 a month on the rents. You got another nice jump to go from a B minus to a B of almost $30,000, but the sweet spot If you can buy a B-class 1980s, 1990s asset and truly value add it to a B plus to that level, you've got $60,000, $70,000 a unit jumps. Now keep in mind, these B pluses are real nice. The B pluses are at the same remodel level almost as new construction, and so the locations are also very good. So that B class asset, you need to be as late into the 1980s and 1990s as possible and value added to almost new construction levels to be at a B plus. And it's not too bad that you're getting $300 a month jumps in doing so. Okay, I'll just touch on student. The reason the student GRM is a little bit lower is, keep in mind, student housing includes lots of expenses that the tenant doesn't have to pay. And so that sort of lowers the net amount, which means someone's willing to pay less for the rent coming in. But nonetheless, it's $148,000 a unit. We're averaging $65,000 a bed. I can tell you though, very good assets that are a very close or walkable distance to a university can easily be $100,000 to $150,000 per bed. The one thing to point out on the affordable housing side, look at this, over 17 closings, mid-1990s construction, $130,000 a door for affordable housing, bringing almost $1,100 a month rent. That's now affordable housing in our world. You will see when we go over the affordable stats for under 100 units that these numbers are dramatically less. And the reason that exists is because most of the larger institutions like nationals and REITs are the ones buying affordable housing because they want to be able to place lots of money at one time. There's better incentives when they're buying bigger assets, so they're willing to pay more per unit. Now we're going to dive into the under 100 unit stats, and I can tell you from historical, the under 100 unit stats have now really jumped up in the prices and the rents, because what I have found as a multifamily broker is a lot of the folks who are buying 100 plus units are seeing less and less deals in that realm, and so they've now morphed their plan to be able to buy some of those smaller assets, especially in markets in which they already own 100 plus units and can run those smaller assets out of the offices of their larger assets. Now, the guys who are buying 200 unit deals are not necessarily buying 10 and 15 unit deals, but they are buying in that mid-range of 50 to 100 units. Okay, now we're looking at the under 100 units. The first thing is the 82 total closings over the trailing 12 months represents, again, just a few above the trailing before that. So we're on target. Average age, 1970s. We're running $100,000 a unit overall, about $840 a month rents, and nearly a 10 gross rent multiple, which is just a shade less than the 100 plus units. I can tell you historically that was in the 6 to 7 range back in the past and has slowly been creeping up until the last 12 to 18 months when it really jumped above 9. The next thing you'll see is there are 0 Class A closings. Again, as I told you, Class A is traditionally new construction, and nobody builds under 100 unit complexes anymore, particularly in the state of Florida, because land is so valuable. By the time you buy land constructed today's closing costs, you can't earn rents high enough to do a small project. That's why everyone builds at least 200 to 250 units to make it worth the land and construction cost. Another interesting stat, look at this. The Class B closings overall are 22 and Class C is 60. So 60 of the 82 listings are in the Class C, which is about 73%. It was only 28% Class C closings for the 100 plus. And again, the reason I told you that is because Class C traditionally is those 1960s, 70s assets. And because you can't build them anymore because costs are so high, these assets continue to get older and older and older. And until they're value added to a B level, which is happening more and more, they'll continue to be Cs until then. Once again, same thing on the under 100 units. Nice little premium if you can take a B to a B plus, but as you can see, that doesn't happen very often. B minuses has 12 closings at $120,000 a door and over $950 a month rents. And Class C is where most of the activities is. Like I said before, 1960s, 1970s. You got C pluses going for over $105 a door and $850 a month rents right now. Class C is at $85 a door, and C minus minus, where there were no closings over 100 units, there are 10 here at about $60,000 a unit. So the worst of the worst, sometimes boarded up, high delayed maintenance, bad locations, still getting at least $60,000 on the C minuses. On the student housing stats, not much to go over there with only 5 closings. On the affordable housing with 10 closings, $81,000 a door compared to $130,000 a door on the 100 plus units, and they're bringing in about $850 a month rents. As you can see, pricing is still very strong in the state of Florida, particularly in the northern half of Florida. For instance, those pricings represent about 15% jumps in the overall scheme. So if you're one of those investors that's waiting on the sideline for the world to collapse and pick up good deals, I don't see it happening anytime soon in the state of Florida. I'd get in the game, still keeping to your pro formas, and getting as aggressive as you can on offers because there's still competitors on every deal. I hope this video brought you some value, and if it did, please hit the subscribe button. Make sure you hit the notification bell so you're aware of each video. And of course, give me a like. Comment below if there's some other stats you want to hear about on the next monthly update. See you guys in the next one.